All right, we're setting up a new trade in SPX. This is a standard 112 bear trap using April 14 expiration cycle with 52 days until expiration. This is going to be a slight variation. Instead of using a 30-point wide put debit spread, I'm going to use a 40-point wide put debit spread. And I'm going to sell 2 times as many farther out of the money naked puts to cover the cost of the put debit spread. So the difference between a 30-point wide put debit spread and a 40-point wide put debit spread is that 40-point wide put debit spread is worth a little bit more if the price is going to end up in the money, or if this put debit spread is going to end up in the money at expiration. It's going to cost a little bit more. So if we compare a 30-point wide put debit spread with a short out of the money put and a 40-point wide put debit spread with a short out of the money put, we are collecting a little less credit up front with a 40-point wide put debit spread, but we have a potential to make a little bit more if the price is inside the put debit spread at expiration. So we take a little less money up front, but we have an opportunity to make a little bit more on the back end or at expiration. This also is going to give me a little less positive delta. The market has been coming down last couple of days, and positions that I am carrying right now, they are short gamma, which means that on the way down, I'm going to overall accumulate more positive delta. So I don't want to put on a new trade that's going to give me a ton more positive delta. So I'm okay with starting off a trade such as this 112 bear trap, and I'm getting a little less positive delta to start with. And if the market continues to sell off, this position is going to accumulate more positive delta on the way down. And we can see here, this is a 5 lot. We're starting off with about plus 27 delta. And if you follow the price on the way down, you see delta starts to accumulate. And it doesn't take much. The market goes down, 25 points, and my delta goes from plus 27 to plus 42. So on the way down, this position is going to increase net positive delta in this trade. I want to start off with a little less positive delta than I normally would if we were in a place where the market had just sold off and we're trading near some sort of support. For example, if we were somewhere around 3,800 and I was looking for a move higher, then I would be willing to take on a little more positive delta to start with, and I would, instead of using a 40-point wide put debit spread, I would use a 30-point wide put debit spread, or I would go maybe slightly further out of the money on my put debit spread, and that would also increase my net delta to start with. So for right now, this is my trade. I'm buying 3940, 3900 put debit spread. And for every one put debit spread, I'm selling 2 of the further out of the money puts naked. Do be aware that selling options naked has a ton of risk, and using SPX options, this could potentially require a lot of margin. So plan for margin to possibly expand. The puts that I'm selling are at 33.50 strike. They're currently going for about $10. And the put debit spread that I am buying, this is a 40-point wide, and my long option is at around delta of 37 or so. This trade is currently going for about between $8.95. I saw prices as high as $9.25. I think a $9 credit is a fair price for this. So we're going to try for a $9 credit. Now, potential outcomes here are if we are above the long leg of the put debit spread, we're above 39.40 at expiration, we get to keep the $9 credit that we collect up front. If we are inside of the put debit spread and the short out of the money put, this is bear trap profit. This put debit spread is worth 40 points or $4,000 for each one put debit spread. So we have $4,000 gain here, plus the $9 credit that we're collecting to put this trade on. And our short out of the money puts would expire worthless. So inside the trap, this is where we make the most profit. We make 40 points plus $9. So we make 49 points here, or $4,900 per one bear trap. And then the scenario that we don't want to see is the market continues to sell off. We get into the trap early on, and the market continues to go lower. I do plan to delta hedge this position to kind of smooth out my T+0 line, right, to slow the rate of losses on the way down. And my stop in this trade, this is a 5 lot, so we can see that I have a potential inside the trap to make somewhere around $25,000. So if this position at any time down $25,000 to maybe $30,000 in total, that's my stop. I have to get out. I'm not going to fight with it or try to prove myself right. I'm going to stop myself out, but before I do so, on the way down, I'm going to try to smooth my T+0 line just to give myself enough time to see if the price is going to revert back to where it came from, which is where we are right now. So that's the game plan for this trade. I'm going to try to get in for about $9 credit. It's currently showing a mid of $9.15. Good luck, and I will post any updates going forward.